Jake's Wealth. There is no such thing as luck when it comes to trading stocks, cryptocurrencies, futures, commodities. You must have the discipline, rules, and patience like people talk about but they don't explain. You have to know your risk ratio. It's risk management. It's what share price are you going to take on, what's your risk, and how much are you risking of your entire account. Say you have $10,000 to trade. Maybe you can look for a 1 to 3 risk ratio that's currently in a trend. So 1 to 3 would be like if it's $100 a share, you're going to exit the position if it goes to $97 a share, and you're going to take profit and exit the position if it goes to $109 a share. And that can be a supreme, a really good, an excellent support level at 100 a share, or it could be 127 a share. You could run, it's about the risk ratio and how much are you willing to risk. You can risk $10 or you can risk an unlimited amount. So play within your confines until you get good. Don't just go to the stock market and say, I've saved up an extra $1,000 or however much it would be, and say I'm going to buy $1,000 worth of this electric vehicle company, and no matter what happens, I'm just going to keep holding it. That will work in the long run, but you could also do the opposite. You could also lose your 1,000 because you bought towards the top when it was super popular. Maybe it was super popular for that day, week, or month, or year, but it's likely to want to go and find the orders. Like you can start to look at the option chain and see the volatility percentage. Most things fall around 10% volatility, so it's normal for something to go up or down 10%, but then you also want to acknowledge the trend, whether you're using candlesticks or the line graph. Are we in a 1 week trend, a 1 month trend, a 3 month trend, a 1 year trend, or a 5 year trend? Like the top 100s, the top 500s. Those are 5 year trends. Right now in the market, but it could change. It could retrace 30%. And if you're not allocated properly to be on the right side of the trade, it's just cut it. Just take the loss when you feel like it's not going your way, and just take the loss. Don't take the profit. You sell a profit on a slow mover that's in your favor. You're in the money. You sell it because you want to make money and make a profit. Now you don't have a chance to make more profit. So you can trade also with 10% or even 5% of account because it's fun and you like to do it, and the rest of your account can go towards, you could just keep it parked in like the S&P, and you can use a stop order which purchases if the price goes above. In my opinion, the most obvious, great sounding thing to do would be to place a stop order above a breakout. When it breaks out, if price hasn't gone above 110, maybe you want to purchase when it goes above 111. Then you set your 1 to 3 risk ratio, or you let it ride. It's up to you. But if a breakout with no support above, it's like, why sell a profit? Because of compound interest and long term. You can begin by setting your stop loss at break even for an idea. Now you can't lose money. Number 1 rule, don't lose money. Number 2 rule, don't forget rule number 1. Number 3, risk management, in my opinion. Just know how much you're willing to risk if it goes against you. And it's not so easy. Maybe if you're looking at the 15-minute, it's easy because you're wanting to buy something and purchase something and then get out. But if you're looking at a longer time frame, say the 4 hours, an overnight move can happen. So you have to take that into account, possibly set a limit order. There's different ways to set up an account so you could be on the right side of the trade. And the rest is up to you. See you at the top. Watch my other videos, Jigs. Well, thank you.